information about money. We say on this show, money encompasses everything, but tonight we're going to talk about money, investing. Why? Because, we have a great guest friend of the show with us tonight. His name is Paul Merriman. Paul been in the industry for over 55 years, and he actually built one of the top-rated investment advisory firms in America. Now, in retirement, he's spending his time teaching families, people like you, people like me, how to, in the simplest way, to do it yourself investment. So, because so many people are always looking for help in that area, and they're sometimes looking for high paying, managers. You don't need to do that. He's going to teach you how to do that. His organization, a nonprofit organization, through his website, has been teaching and educating and empowering families just like you and me. Paul has many accolades, many accolades. Actually, the American Association of Individual Investors awarded him in 2021 Investment Educator of the Year. He also has a podcast called Sound Investing, and Money Magazine, for those of you who follow Money Magazine actually named his podcast #1 podcast in 2008. He has written multiple books, 8 books to be exact. One of them, it's called We Are Talking Millions. That's why he's here tonight, because we want to talk about how to make millions before retirement. So without further ado, I would like to welcome my new friend to the show, Paul Merriman. And he's going to quickly introduce himself and everything that he's been doing in the last 55 years. And then we're going to dive into this very important conversation. I know we started offline, but listen, you want to share, tag, let your friends know that we are on tonight. This conversation is for you. It's for them. It's for everybody that you know. So, Paul, thank you. Let me just say first, I had, when the first time I talked to you, I was like, Paul, I'm a person from a particular community. We like to call everybody Mr. who are older than us. And you're like, no, call me Paul. So yes, I'm calling you Paul tonight.
Good.
So Paul, please share with us a little bit about yourself.
Well, 55 years in 55 seconds, huh?
Yes.
Well, I was a stockbroker for 2 years before I realized that was a difficult business to be in, terrible conflicts of interest. And I found my way into a number of different businesses as a young man. I was married when I was 19 and going to college. So I was always a worker bee, trying to make a living and always looking for opportunities. And I found a couple of opportunities that allowed me to retire when I was 40.
Wow.
And what I wanted to do then was, when I say I retired, I'm a workaholic, and workaholics never retire, I don't think. Right. But what I did do was I started an investment advisory company. And it was a different kind of an advisory company in that we build it by showing people how to do everything on their own. So they wouldn't need to pay somebody 1% to get it done. Wow. And we said to investors who went to my classes, if you won't do it yourself and you understand now how we do it, then if you need to, we're happy to do it for you. And that was how we built our business, by showing people how not to hire us. But, many of us spend a lifetime on a diet and never actually win. And I'm one of those people. I don't have the discipline to diet, and other people don't have the discipline to take care of their money. So that's how I built the business. And then about, a little over 10 years ago, we sold the business. And by the way, that award that we got for one of the top 50 investment advisors in the industry, the truth of that story is they got that award after I left the company.
Wow.
So I don't know if I can take credit for that or not, but I do know this. I do know that almost everybody, if they can get over the emotional humps and challenges and hurdles of the process of investing, because money is something we're very emotional about. Right. If we can take that emotion out of it, I really think that I can help, and lots of other people can too, help you take the right steps to be a successful investor. I can't guarantee it, but I can tell you that I guarantee to do all that I can, that you will learn how to do that. And that is what we're committed to, because for the last 10 years, I've been running a financial education foundation. We don't sell anything. We have free books. We have free everything in an attempt to help you take care of your finances and not only build a better financial future for you, but for your family. That's our goal.
Yeah, definitely. That's a great goal. Educating, empowering. When I received the call from your admin, and she said, I would like for Paul to be on the show with you. I was like, how why did you hear about Gabrielle? And she was like, you know what? I found a way to find about you. But you said you couldn't take credit, but the information that I have here, when you sold that business, asset under management, and for those who are familiar with the industry, you had $1.6 billion in asset under management. And for me, who's familiar with this industry, I just thought, how many families were you able to help? And that's an amazing thing, because that's what we need to do. And when we go into financial services, we are in the business to help families. Now, we were saying, like on this show, we said how important it is to plan. And we talk about financial planning. But tonight, we're going to be talking about investing specifically. So can you share with those perhaps who are not as well versed about the industry, the difference between financial planning and also investing?
Yeah, absolutely. Because planning takes into consideration all of the aspects that you're going to deal with financially. And so that includes insurance, it includes estate planning, it includes getting a mortgage. There's all sorts of aspects of financial planning in and around investing. But I've always felt that at the heart of it all is to be a good investor, that to the extent that you're going to become financially independent, you are going to have to get the investing part right. And so our work is not about insurance and estate planning and taxes and all of those things. We want to show people very specifically what kinds of mutual funds or ETFs they should invest in, how to combine different kinds of ETFs and mutual funds to get a better rate of return and maybe even reduce the risk, and how to do it in a way that is in your best interest. Because believe me, Wall Street would rather that you act in their best interest, because that's when they make the most money. I want you to make the most money. And so that's why we focus on really just a handful of important decisions. This is not complex. I teach high school classes and they get it. They understand the process. I know that you can as well. You just have to get over the idea that it's complex, because it is not complex.
Yes, it's not complex. That's why tonight's show, the topic is the magic behind investing matters. And when we were talking offline, actually yesterday or the day before, you said, Gabrielle, there's no magic at all. There's no magic. So can you, what exactly did you mean by that?
Well, there is a form of magic. Remember that we are dealing with the unknown. And so in that regard, there is some magic here, because nobody, I don't care what school you've gone to, how many PhDs you got, you can't know the future. Nobody can. So we are moving into the future without the knowledge of exactly what's going to happen. But magic is an interesting thing. When for my birthday, my 80th birthday party with the family, my wife got a magician, and he came to the house, and it was an absolutely wonderful time, because we got to watch these amazing magic tricks right there in front of us. And he was also, by the way, a mind reader, and that was certainly interesting. But the bottom line is that the magic that he does comes from practice and practice and practice and discipline and over and over and over again, a commitment to do something right. That's where the magic comes from. Mm-hmm. And so my belief is that with investing, the magic is about you and your commitment to doing the right thing. Right. And I think this is the good part, that the right thing is no more than one fork in the road away. In other words, if you have to make a decision between stocks and bonds, well, you need to know something about stocks and bonds. And once you know that, it's obvious what you should do.
Correct.
And you might say, no, that's way too risky. And I say, look, let's look under the cover. Let's find out what is more risky over the long term. And so you take one decision at a time. And all of a sudden, you have taken what looks like a complex series of steps and made it dirt simple. Because the fact is, investing has never, ever been as easy and as efficient and as productive as it is today. Because I've been around it since 1963, and it was not this way then, not at all.
Yeah, that was going to be my question, how things have changed in terms of the industry. But I wanted to ask you, because I know you say it's simple, it takes discipline and practice, but I love the word infallible. Nobody's infallible. You can make a mistake. You could choose the wrong stock or the wrong bonds, or you could come in too late or too early. What are some of the worst and the best investment decision you've made?
Well, you just hit on one right there, Gabrielle. You said that we are not infallible, and we might buy the wrong stock. Yeah. Well, to begin with, I don't want you buying any stock. I want you to buy a diversified portfolio of 1,000 companies. In fact, literally with $100 today, and I couldn't do this 60 years ago, I can have a portfolio that only a multimillionaire would ever hope to have because of the way that we can now buy mutual funds and ETFs. So the first thing I want to make sure that we don't do is take steps that are likely to hurt us more than help us. And anytime we buy an individual stock, we are taking an unnecessary risk. And that is, that stock could go out of business, totally out of business. And you'd lose everything. And yet with that same money, you can buy the whole S&P 500. Right. And have all of corporate America working for you day in and day out. And so these kinds of decisions, and as far as the mistakes I made this very mistake. I tried to speculate when I was young. I tried to make the killing. I tried to figure out a way to get rich quick. Right. And when I found out a way to get rich quick, when I doubled my money in a matter of a week, I did it again. Except I didn't double it the next time. I lost it all. But I was like so many young people chasing fads, chasing easy money. It is not ever about easy money. People can win lotteries, but the probabilities are not very good. And the same with investing. If you want to be speculative and try to hit the home run and get rich quick, the odds are you're going to fail. The probabilities are you're going to fail. And by the way, that even includes the professionals, because the professional managers cannot even beat the indexes, where any fool could put money into an index fund and get a better return than most all of the high-paid professionals. So there are some easy decisions that we can make, but we get trapped in this idea that we're going to get there quickly. And at age 80, I will tell you, I have not found any evidence other than lottery tickets that you're likely to get there quickly.
Yeah, if you are one of the lucky ones. So again, you mentioned discipline. It's doing it in a way that's not speculative. Not, you don't want to be a speculative investor, someone who's chasing a win. You want to be disciplined. So I know when we were talking, you mentioned about your passion for young people and for all people, but especially for young people, because of all the opportunities that they have. The best opportunity and the number one opportunity is time. So
Yes.
for someone who's young, who's thinking about, you know what, I want to prepare, because in our introduction, we said your primary goal is to help empower investors so that they could have a secure and comfortable retirement. So
Yes.
young folks who are watching, because our audience starts at the age 18, I look at the stats all the time. The bulk of our audience, the members are between 18 and 54, I believe. So where do they start? How can they get, so what are some of the easy steps investors can take right now?
Well, the obvious step they have to take is to be willing to save. And the earlier they can save, the better off they're going to be, because that time, that asset that you mentioned, Gabrielle, that is so key. The first 5 years of saving can end up being worth as much as 30 or 40% of what you have when you retire. That first 5 years. And you're going to come to a fork in the road. If you're going to save and invest for the long term, do you want to save where you don't have to pay any taxes? Well, I would, if I were young, again, I would want to save where I'm talking about long-term money. I'm not talking about money for the down payment of a house or sending a child to college. I'm talking about retirement money, long-term important money that you're going to, when you quit working, you're going to be paying yourself. And I want to make sure you pay yourself as much as you possibly can. And so to be able to do it tax-free, which of course is a Roth IRA, that's huge. Never have to pay tax on that investment. So now you know that probably the smart thing to do is to put it into a Roth IRA or a Roth 401k if you happen to work for a company that has that. And particularly if they're matching some of your money, you don't want to miss the free money. I mean, you're just bending over and picking it up off the ground. And so that's extra free on top of not having to pay taxes. So then you come to this decision. Okay, if I'm going to put money away for the long term, where should I put it? Well, I want you to invest like a multimillionaire from the first day you start investing, which means I want you to be diversified like a multimillionaire. And as I mentioned earlier, that's going to mean putting your money into a mutual fund or an exchange traded fund where you automatically are diversified like a multimillionaire. Now, you could buy one where you pay a load or a commission. I don't want you to pay a load or a commission. Why would you pay somebody else if with education, and in fact, on our website, we even tell you the no load funds to invest in, but with an education, you can eliminate that commission to buy that mutual fund. Now you have not only your money working for you tax-free, but you also have it at no cost to get into that investment or to get out of that investment. But then you come to this fork in the road, and it's such a simple fork for the long term. As a young investor, do I want to put my money in the stock market? Or do I want to put my money in the bond market? And let me tell you what I just love about bonds. They're guaranteed. The government bonds are guaranteed to give you your money back plus interest. You don't take any risk any single day except for inflation. can eat up all of that interest that you get, but without inflation, it is a perfect investment except for one thing.
Yeah.
Because it's guaranteed, it doesn't pay anything of any significance. And yet the stock market for over 90 years has compounded at about 10% a year. Now, 10% versus 5%. And by the way, it's important to know, those of you who are afraid of the stock market, if you look out 40 years, and if you're a young person, that's what you're talking about, the worst return the S&P 500 has ever gotten is 8.9% a year over 40 years. And the best it ever got was 12.5%. So now you've become a saver. You looked for a place to do it where you didn't have to pay any taxes. You did it in a place where the money was likely to compound. And oh, by the way, if by chance you start investing and the market goes down, hallelujah. I mean that. I'm talking about it is time to party if the market's going down, because the money you're putting in is buying more shares. It's called dollar cost averaging. And when the market is down, that is good when you're young. I don't want the market to go down because I'm old and I want it to go up all the time. But for young people, going down gives you a chance to buy more cheap shares. And the best markets that there have ever been have been after the market was down and dirty and feeling like it's not a safe place to be. In fact, that 12.5% return started in 1932. You had been there right at the bottom. You were there for one amazing long-term ride. So it's all very simple, but it doesn't feel simple because Wall Street wants you to get involved.
Yeah, and I think because of fear, we mentioned how the struggle. When I first started in banking at 21, I remember families and individuals coming in who were talking about that. Folks are coming in to find out if their Social Security was deposited because of the fact that they had not done what you just mentioned here. Be disciplined enough, start early, be disciplined, dollar cost average when the market is down. And basically the essence of it is to be in, to make a decision to invest. So with all the fear of investing, what would you say to someone right now who's young, but who's saying like, you know what? Last week we talked about trust. I don't trust anything but the checking account at my bank. And I don't want to do anything but put my money someplace that's not going to be compounding or that's going to not have the same outcome as the stock market can do for them. What would you say to that person?
Look, here's what you've got. When you put your money into either the total market index or the S&P 500, these are very popular investments as an index, low cost, no load, everything in your best interest, huge diversification. What you have is you are an owner of probably 5,000 companies.
Correct.
And if you go out in your city and you drive by those companies, and they've been around, IBM has been around for a long time. You could make a list of, Microsoft, and it could go on and on. They're all part of what's in your portfolio. The reason I want you to own 5,000 companies or 500 companies is because some of them will go bust. Enron was the 7th largest company, public company, and it went belly up. Correct. And the market just kept marching ahead. Now, I don't mean to imply the market always marches up. It doesn't just march up. It marches down part of the time, too. In fact, it's important for you to know that about 25 to 30% of the time, the market's going to go down. Now, by the time we get out to 20 years, you don't expect the market to be down. You expect the market to be up. but you will have gone through ups and downs to get there. But the bottom line is what you are betting on is the success of thousands of public companies that generally are well financed, that generally are well managed by people who know a lot more than I do. But every morning when I get up, I know there are people going to work, working for me as a shareholder in all of those companies. I mean, I may have more of those mutual funds and ETFs than you do, but I own the same companies. And you benefit just in the proportion that you've invested. So if you've got $100 invested and the market goes up 1%, you made $1. If I have $1,000, I just went up $10.
Correct.
And so it's all relative. Nobody has the advantage.
Yeah, you just have to get started and you just have to be disciplined. I give you one example. I know someone who came to this country in the 90s. She started working for a hotel here in the United States, and she heard about retirement planning. She didn't know, she didn't even understand the language. Yeah. But like someone like me, she'd said, okay, what do I sign? Where do I sign my name? And she signed up for her retirement planning at work, the 401k. And just like you'd mentioned, the company would match. Every time she put $1 in, they gave her 50 cents. In addition to the match, she was getting return on her investment. Long story short, after 30 years, the same woman who still knows very little English retired with over $400,000 in her retirement account. So much more. And she was so disciplined, not only with that, but with other aspects of her life. Because usually when people are pushing back and they're not willing to be disciplined, they're waiting for a big, like what did you say earlier? You said like the lottery. They're looking for a lottery ticket. They never really apply discipline in any area of their lives. So it's very important to start applying discipline, especially when it comes to the fact that we're all gonna get old. If we are lucky enough to live a long life, right? You're gonna get older, and therefore you're not gonna be able to work. What you sow right now as a youngster is gonna be the harvest that you're gonna reap as an older person. So you mentioned the book that you've written, We Are Talking Millions, and you have 12 simple steps to supercharge your retirement. And I know you've shared so many of them already right now. What are some of the other ones that folks should know about of one of the 12 simple steps? And the book is available on Amazon as well.
Yes, it is. It's at Amazon, or you can get it free on our website.
Okay.
Now, the $1 million decision, those 12, what's important for folks to understand is each one on its own is $1 million decision. Yeah. So if you could only do 2 or 3 of them, that would be good, because that would mean you ought to have at least $2 or $3 million. Now that may sound too hopeful, but you know, if you put away $1 a day from the day a child is born, and you do it until they're 21, and you invest in the market, okay? And then you convince them to continue doing it, $1 a day until they're 70 years old, because that's when they're going to be retiring people who are being born today. That would be worth somewhere between $2 and $4 million. Right. And a lot of that's going to come, in fact, most of that's going to come from the first 21 years. So it's just getting that base, that foundation built. And the reality is that it's the same discipline as investing or buying lottery tickets. It's the same thing. If you think about it, in both cases, you're hoping for a payoff. The difference is your odds of winning the lottery are about 400 million to 1. Your odds of getting a return on your investment over the next 40 years or 30 years or 20 years, I can't say it's guaranteed. Nobody can. but it's as close to guaranteed as I know anywhere in you could invest is in the stock market over the long term.
Right.
And so it is a matter of building that foundation, and it takes about 10 years. There's a page of on our website, we have a lot of tables, and one of those tables assumes you start with $1,000, $83.33 a month. And at the end of the first year, you started in 1970, that's what we assumed, you've got about $1,022,000, which means you made $22 in the market that year. It was not a good year in the market, but you had $1,022 because you put in $1,000. So you're the hero, not the market. Even if the market was up 10%, okay, you'd have $1,100 instead of $1,000. Still not a home run. You were the home run. Yeah. And then you keep doing that. And after a while, what happens? It's just the nature of compounding. What happens is that you've put aside enough money that the money that's being made on your money is more than the money you're putting in. And you have to go through that process to get there. Now, with a lottery ticket, the payoff is you win $1 billion. But you never win it because the odds are 400 million to 1. Yeah. In the case of the $83.33 a month, you are putting it into something that is virtually 40 years from then, guaranteed to have grown in value. Now, I can only say guaranteed based on what we have from the past. Who knows? We may not survive climate change. We don't know. But from everything we know, the odds are you will be paid a huge premium for having done that. The problem is you have to trust all of these companies. You have to trust those people get up, they go to work. You have to trust people buy their products. You have to trust they pay their bill. I mean, all of those things that make our society and the capitalistic system, which a lot of people don't like, but it's what we've got, and it's how these companies have grown to be what they are today. You have to trust that process, or when it starts going down, guess what? You're looking for a way out because you're afraid you're going to lose everything. That is how the human mind, there's a great book called Your Money and Your Brain. And it's all about how the brain responds to these kind of financial decisions. I'm not going to say we're all crazy, but I will tell you, we act like we're crazy because the brain gets emotional about money. Yeah. As it should.
Yeah, the fear is real.
The fear, yeah.
But the only way you can overcome fear, I believe, last week we talked about trust matters. And the only way you can overcome fear and overcome your lack of trust is through knowledge and discipline, and also doing your own research. And if you're not able to do your research, I commission you to encourage you to commission your kids so that they can help you, because they're doing something that you, like, for example, the lady who does your social media, right, Paul?
Yes.
You've commissioned a younger lady. Her name is Renee. And I was like, oh, Renee, you do? Yes, I do all his social media work because, hey, he didn't want to do that. So it's very important to know that there are ways. You talk about the discipline ways to supercharge your retirement. And you have resources available on your page, which is paulmerriman.com. Now, before we go to the resources, let's talk about the work that you're doing with Western Washington University. Because again, offline, I was saying, Paul, I worked in banking. I remember folks coming to the bank. I was a youngster saying like, I have a checkbook. Why can't I write a check? And if folks are having a hard time writing checks, and they still do today in 2023, understanding that you need to have the money to back up the check that you're writing, how much more folks are not getting ready for retirement, getting ready for other important aspects of their lives. So why are you investing? Why are you doing the work that you're doing at Western Washington University in Oregon?
Well, 10 years ago, and by the way, Gabrielle, I don't want to forget to talk about target date funds
Oh
before I
yes, oh
leave.
yes,
Okay.
yes. Please, I'll remind you after this.
Okay. Thank you.
Okay.
At my age, I need reminding.
Yes.
So, um, I, when I retired and I started the foundation, I thought I was probably going to set up some sort of a scholarship fund for students at Western. It's a campus of about 15,000. It's where I graduated, and I loved Western. It was a great place to be. As I said, I got married at 19. I had my first child while I was a student there, and working nights as a night watchman on campus to make ends meet. But my wife said, come on, you can do more than just have a scholarship fund. Isn't there something you could do that would help these young students? And so what we decided to do was I went to the administration. I said, I want to sponsor a class on investing, not about personal finance, but I want to focus just on investing. And what I wanted it to be for seniors only. So they'd have this class right before they get out of college. Mm-hmm. And they agreed, as long as we would write the check for the class and in essence pay for the instructor. They started the class, and it has been full every quarter since 2013. Wow. But I realized a couple of years into it that I was only helping about 200 to 300 students a year, right, because there was a limit as to how many students could take the class. And so I started lobbying the school into the idea that we should have a class that every student takes that will give them the real important basics, from budgeting to insurance to mortgage to 401ks to all of the things that are important to a young person as they come out of college. And at first I thought nobody was listening. And finally I asked, okay, how much money is it going to take to make this happen? Because I could tell they liked it. And they gave me a number. And it was a big number. I knew if I gave that money to Western, my kids would say, well, Dad, I mean, what about us? So it was a big decision. Yeah. And by the way, my kids are doing just fine. I'm not worried about them financially. And so they gave me a number. I said, okay, we will do that. And now within just a couple of years, every student who comes through Western will have about 40 hours of financial literacy. And the reason I'm doing this is it's really what I think philanthropy is about. I mean, we have time, and we can give time, and getting people's time to help others is very important. Yeah. Then there is you can teach, you can be a mentor. It's another kind of time that you can apply. And then, of course, you can give money. And when you can give money, that it does something that changes somebody's life forever. And I realize there are lots of people who they don't have enough food to get through the day. And so I'm in competition, if you will, with people who are trying to solve problems for people today so they can stay alive. Well, that's great. And I'm all for those kinds of projects. But this is an opportunity to have the money go to something that will be an endowment and will support this effort. I hate to say forever, because that starts to sound like guaranteed, but at least as close to forever as we know how to create. And we were the first people to put the money in. I promise there will be other alumni who will come in and support this effort. But it was a big obligation, but it's what our work is about. And you will never retire, Gabriel. You will never retire.
Paying it forward is something that's very dear to my heart because I tell folks all the time, they're like, why are you doing Let's Talk Money with Friends? I'm giving back what's been given to me because I know when you say your alma mater, you're giving. Can I say how much money you gave? No, don't say.
Oh, it's public. It's public.
So $3.6 million that you give to your alma mater to start an endowment and to have given that much money. I remember going to school, being a poor foreigner. I needed money. People would checks for me. Like all my degrees were given to me to check. Of course, I had to apply myself. I made sure I got my A's and the grades that I needed to keep my scholarship. But guess what? I remember writing a letter, a thank you letter to my grantors, my donors, and I said to them, I'm gonna pay it forward. Let it be known that Gabrielle will pay it forward. That's why it's very foreign to some people that I'm paying it forward so much, because for me, I need to pay it forward. And I'm so grateful that you are paying it forward and that the entire school in Western Washington University, the students are graduating with knowledge that they're gonna need, knowledge that they can use for their own households, and also paying it forward by helping the community. So we talked about the target age fund. So we go back
to
your own personal responsibility. If you are someone who's young and you want to be ready to take off yourself so that you can even pay it forward in the future because you're accumulating enough asset, one of the ways is by setting up a target age fund, right?
Well, the reason the target date fund is so near and dear to my heart, and that book, We're Talking Millions, the last half of the book is about target date funds.
Yeah.
There is no other investment like it. Right. And there are really three very famous kinds of investments that changed the world. The first was a mutual fund, and that started in the 1920s. And then it wasn't until 1976 that we get the index fund. That was the next huge breakthrough. And that allowed people to invest in the whole market, basically, with a very little amount of money. And that was John Bogle was the one who brought the first index fund. And then in 1993 was the target date fund. It is the ultimate fund for the investor who doesn't really know what they're doing. And they want to put their trust in the very smartest people that they're likely to have work for them. And these are the people who are in essence the equivalent of a pension trust officer. Many people, when I was young, went to work for companies and they had a pension when they retired. And the reason they had a pension is because the company took part of their money. It's their money. It's the employees' money. And they put that money into an investment that would kind of be like a 401k, except you didn't get to get it until you were, let's say, 65 years old. But that money was put into a pool where it was managed professionally for all the people in the pension. And it was managed in a way that it was highly probable that it was going to meet the needs of the individual's cost of living when they retire. Now, if they had a high cost of living, it might not work. But if they had a normal cost of living, that and Social Security was going to be plenty, and is still plenty for lots of people. Those pension trustees had to make decisions, how much in stocks, how much in bonds. And they invested on behalf of all of the employees. I mean, these are high-priced people. These are not people on Wall Street trying to figure out how to hawk a stock to somebody to make a few bucks. This is the very pinnacle of the best work that has been done in terms of for the good of people's financial futures. The target date fund is the same thing. You start, let's say that you want to retire in 2065. You buy a 2065 target date fund. And it is managed just like those pension funds were managed, so that you would be mostly in stocks in the early years. And then as you reached retirement, they would start moving you into bonds. Remember, bonds are safe because by the time you're my age, I'm 50, my wife and I are 50% in bonds and 50% in stocks. We're pretty conservative because we don't need a home run anymore. We just need to conserve and preserve what we have. But the target date fund makes every decision. You don't ever have to make another decision about that money. You don't have to worry whether it's well diversified. I promise you it is well diversified because you are in with millions and millions, trillions of dollars being managed in the same fashion. Now, you will also note in the book, I show you one baby step you could take. And that baby step would probably make you about another 1%, or at least another $1 million, okay? But here's the thing I love about target date funds, because I love numbers. Wharton did a study along with Vanguard, and they looked at 1.2 million accounts at Vanguard. Many of them were all in target date funds. That's all they owned. Other people had no target date funds. They knew better. They thought they could invest in a way better than those pension trustees, if you want to call them that. Those people who didn't use target date funds were built to make 2.3% less per year for the rest of their life. 2.3%. That is every 0.5%. You'll find that in the book, we're talking millions. I make the case every extra 0.5% will lead to another $1 million. And you can follow the bouncing ball in the book if you want to, but that's the bottom line. We're talking about somebody who knows nothing about investing, putting money away into a pension-like investment that will be totally managed at a very, very low cost. I mean, you talk about when I was in the business back in the 60s, we didn't have no load funds. So there were a couple of them. Funds had an 8.5% load to get in. Today, 0 load to get in if you know where to go, and that's where we want you to go. And mutual funds cost 1% a year to manage. These target date funds charge 0.08%.
Wow.
So you are being treated
well,
like a very wealthy person from the first day you put money in there. And I hope if people read my book, they will read about the target date funds, because for most people, that is going to be their path to hitting the home run for the long term.
Correct. Yeah, you got to be disciplined and you got to do it. You cannot sit on the sideline and waiting for things to happen to you. You got to make it happen. And we talked about the resources that you have available on your website. Those resources are free. I was on the phone with you, Paul, and I said, Paul, why are you doing this? What's in it for you? And just like so many have asked me, and you said, Gabrielle, no conflict of interest whatsoever. I'm not selling anything. I'm just giving free information, free knowledge available to you. So in addition to your website, you do have a YouTube channel. We mentioned the show that you do, the podcast, Sound Investing. Yeah. And some of the books, they're already on PDF for free. The books that we mentioned, you can either buy a hard copy or download a PDF for free. Correct?
Yes.
What else? I know you do pre-recording classes.
Well, let me tell you, for the people who want to get serious. I mean, if you're not wanting to be a serious investor, I really think just go get a target date fund. And that's not a flip comment. I really mean that, because it will be taken care of day in and day out, and you just don't have to worry about it. Now, if you want to get serious and you want to be a successful investor, in essence, you are a do-it-yourself advisor. That's what you are. And if you are an advisor, you have one client, the most important investor in the whole world. And so you have an obligation, if you're going to be a do-it-yourself investor, to understand what an advisor needs to understand. I'm not talking about insurance and estate planning and all. I'm only talking about investing. It's the easy part of the whole process, I promise. Now, we have a thing called boot camp. And if you go to boot camp on our homepage, there's a drop down and you're going to find out that there are about 8 different topics. These are the biggest decisions you're going to make. And in each case, you're going to find an article, you're going to find a podcast, and you're going to find a YouTube piece. And you're going to find tables of numbers, because those numbers tell the story from the past that I want you to know. For example, I don't want you just to know how much money you would have made if you put all your money in the S&P 500. I want you to know how much money you would have lost along the way. So you will have to look at a table that says, if you do this, here's how much you're going to have to lose along the way based on history. Because if you don't know that, you're not educated. You're not prepared. You need to be prepared for the ride. And once you get that, and once you experience it with a relatively small amount of money in those early years, you're going to get it. It's not complex. High school kids get it. You just need to get the basics. And then my email, paul@paulmerriman.com, I try my best to answer questions that people ask. Oftentimes I answer them in a Q&A on a podcast or in a written newsletter we put out. But the bottom line is that we try to help people over the hump. I do not give personal advice. I can't give personal advice. I'm a teacher. And a teacher is not allowed to give personal advice. A registered investment advisor is. And I was one of those for 30 years, but now I am a retired full-time teacher and happy to help as best that I can.
Yeah, that's what we can do here on the show too, is teach. And I think we've taught a lot tonight. We're encouraging everyone to understand money is what money does. You got to do something with your money. However much you have, you got to start early. If you are young, and even if you are of a particular age, it's never too late to start somewhere. Are you going to be able to accumulate as much as a 20-year-old? No. But if you start today, you will get somewhere. The sooner you do, the better the outcome will be for you. Right. We talked about there's no such thing as guaranteed. We were not giving specific investment advice today because we're not your advisors. We are your teachers, right?
Right.
You are teaching. So no guarantees when it comes to investing. You gotta follow simple disciplines and principles. Your success lies in your discipline, right?
That's it.
What you do and your staying power, not being afraid. And you overcome fear through knowledge and education, right? And that's what resources are available through your website, Paul Merriman. Website. You can reach out. And of course, Let's Talk Money with Friends every Wednesday at 7:00. We have endless resources for you. Tonight was one of them. Yeah, Paul, thank you so much for joining us.
Thank you, Gabrielle.
What would you like to share with our audience?
My last words would be to control what you can control. And then understand you have to leave the balance to fate and faith. That investing is, at the end of the day, a process of faith. And that faith is not a religious faith. It's a faith that this society will continue and will grow and flourish. And by the way, I think it's important to understand, even in countries where they don't seem to flourish so well, generally speaking, their companies do very well because international markets do as well in many cases as U.S. markets. So anyway, I hope you all find some value in our educational material. And the best thing that I get, the highest payment I get, is when you pass that along. When you pass along that PDF of We're Talking Millions to a friend, you have just done a huge thing for me. That's as good as you writing a check to me, is just pass that information on. Let's change the world. And Gabriel, you are doing it yourself. And I'll come back anytime you got some questions you need answered. I am willing to help. Okay.
Well, you're a friend of the show for life. And
Okay.
I'll be more willing to help you on your podcast anytime. Definitely. Listen, the time is always now. The time is always now. So go out and do it. Check his website, Paul Merriman website. Get the information you need. Do not procrastinate. One of the ways that we lose out all the time is through procrastination. You don't want to procrastinate. You want to do it now. Thank you so much for watching. Thank you for sharing and passing this along to a friend. You have friends and family members, community members who are looking for resources like Let's Talk Money with Friends. You need to share this. Do not keep it private, because I'm paying it forward. Please pay it forward by sharing with your friends and family. All you have to do is click the share button, click the like button, and say thank you so much for the show. That's a comment. Sure. And that will change somebody's life. Thank you so much, Paul. Let's stay on for a minute. I'm going to go offline. Okay. And everyone, thank you so much for your time, for watching. Have a blessed night. We'll see you next week for another episode of Let's